So I've been playing with this new study, this candle overlay study that was shared with me, and I updated it a little bit because I wanted to look at the interior structure of some of these candle patterns and understand better why they form and why they fail. This is a daily. So this is the candle overlay on the day. And you can get this. There's links to it both in my. I have a master Google sheet, and I'll put links in the comments of the video. But this is the daily candle is the bigger one here. So you can see the volatility of a candle is its wicks. So this is like virtual value. But for this candle range, this value is irrelevant except as an indicator of buying and actually selling pressure in this case, because it pushes it down. Same thing with the bottom wicks, but you can draw this as a line that goes from this corner to the other corner, and this is the slope of the rate of return for this candle. Which is pretty steep. This is a good candle. It goes all the way down, and so as it's going all the way down, it bounces down here for whatever reasons. It bounces here and not others. So there's like a 30 level somewhere that like it starts approaching and doesn't quite make it to. So it looks like it's reversing here. And on the daily, you definitely have this. Let me do the highlight studies on hover so we can really see what this is doing. So you see this bigger 3-bar play setting up on the daily, because you've got bottom that matches. It's a pivot bottom, but it's after a long dump. Price can't get above it on the daily here, and then this is where you'd get in. Like once this new candle starts, you risk off of the wick here, and it starts going down, and it never makes it back above there. And as long as it stays below this area in general, this 75-ish area, then this 3-bar play is valid. And sure enough, it breaks through this level, and all of this is profit. And it's a pretty decent risk to reward. I think it's like 1 to 3, 1 to 4, something like that, which is nice. But then the interior candles here, like this candle is the 4 hours, so you can see the 4-hour overlay here is not a 3-bar play. It comes down and then it comes back up again and sort of pushes up and consolidates, and then tries to push down further, and then has this really great curve down on the 4-hour that, to me, this is indicative of a dump. You know, like once it starts having this marching pattern. I think there's VPA candles that you can do that explain that. Meanwhile, the volatility of these candles is, you know, this up and down never really reaches above the value area of the previous candle by all that much, and so that kind of points to this being, you know, going down. So you're looking for a short as high as possible. And sure enough, when like you draw the trend lines on, it's from the macro level. So this is from, you know, 2 days previous, and you start drawing these in. So like at each point here, you have like a peak that you're drawing this from, that you can then use as kind of a gauge for the price action. And so as price moves through, it's at the bottom on the 5-minute. It's at the bottom side of it here, and then it breaks above, but it's still kind of hugging the top of it, and then it veers off. So this is trying to pull in more buyers, but it still can't get above this 75 level, which let's draw the 75 level in for just for reference, so that this is more or less where the on a price level buyers are failing to get above. But then this line, once it let's duplicate this and pull it out to the last peak, which is over here. Once that happens, this is the next peak. This is, for me, an awesome entry for a short, because this trend line has established the price has failed and come back. This is a backside move. This right here, I would short this here and wait for this trend line to break again, and it doesn't until all the way down here. And once it gets down here, this is so 38.79. So you get in at 39.63 and get out at 38.79, and that's a really serious move, you know. And that's all just from looking at this one trend line on the daily, you know, that's not drawn on the daily, because you can see if you were to draw the trend line from the daily, you would actually have it from here to, like, because this is the wick of the daily, to the wick of the daily here, which is, I think it's this one, but it won't let me put it there. And that's not really, on a 5-minute chart, that's not something you can really trade. I mean, it breaks up above it several times there. You can kind of see that this is more pointing out where the trend is of the rate of return. But on a smaller level, you can see that why this candle pattern forms, and why it doesn't even really achieve what it's trying to do here. It just sort of peters out here because you get a double bottom down here at 3,900, which is a pretty big psych level. I mean, again, these are all levels that are formed from risk, and people are risking off of these round numbers. So every time on a smaller scale, when you get to a 10, a 20, a 30, 40, those are all risk levels, and you can see the smaller scale price action reacting to that. On a bigger level, the 3,900 is a higher scale level, and you'll see on a 4-hour chart, if you look at it, you'll see all of the 3,900, 3,950, 4,000, 4050. Those levels get lots of respect on the 4-hour level. I mean, this is where they turn, and this 4,000 here has been a huge level for kind of a long time on the daily. Like, it's been trying to push up, above, and down on a higher scale. So that creates that risk, and that's why, like, when you have at 75 here, price comes up, and you can see on the 5-minute there are plenty of candles that reach above it, and actually on a lower scale the trend is up here, but it never quite makes it through that level. And so you have, and if it did, at a certain point, all of the people who are risking off of this for the daily and the 4-hour at this point will start dumping their shorts or getting in long, and it creates this feedback loop on multiple timescales that propels that price further. And that's what's happening here. You've got multiple timescales trying to push, like, this is the 3-bar play, right? But on a smaller timescale, you've got the 4-hour candles trying to push up above that as well. And they just sort of consolidate, lose volume and volatility. And once they lose volatility, you're finding value. And that's why these trend lines start becoming more important, because as you start finding value, like, you can let's move one over here just to sort of see where it dumps to. After it starts dumping down, you can see it line up here, and then this is where I said I would be getting in short. Once it drops down below that level, as long as it can get down to this line, that's a good bearish sign, and so it breaks through here, which is great, but maybe a little over ambitious, and then it breaks away. It doesn't continue. It just sort of, it doesn't come back up, but it just sort of goes sideways, and that's the lack of volume, and it sort of increases its volatility on the 4-hour here, trying to push back up. So there's definitely buyers down here. This is the 50 mark. So, like, I'm not surprised that this is where there would be buyers, because on the higher levels, it's getting that psychological level respect. And it bounces, it rejects, but it comes back down just below, actually getting down to 44-ish or whatever. And each time it pushes down a little further, that's expanding that range. It's removing some of the risk reasons on these lower levels and pushing them down further. So now if I'm on a 5-minute chart, I'm going to risk down here. On a 4-hour chart, I'm risking off of here, which is where the volatility is on this. But on a daily chart, you're risking below this, and that's a huge volatility spike, because it started here, dropped all the way down here, and ended all the way up here. So the value of this daily candle is net positive. And so, like, you can see all of that from these trends. I mean, once you start thinking about them in the macro and the micro, it all starts making a lot more sense. So, I mean, once you start looking at these, the horizontal levels that are created, the risk levels, they're created by these candle patterns on the different scales, and when they match up, they get a lot more powerful. The same is true of trend lines. When you have a trend line that's matching up on different scales, and by that I mean, like, the number of days that the trend line is, not drawing the trend line from a daily chart, because that's only useful on a daily chart and higher. So I try to draw these trend lines on as low of a chart as possible, usually the 1 minute, but you could draw it on a tick chart if you want absolute, precise, point to point. That would be the most accurate, but tick charts don't have a lot of history on them, so it's harder to draw them in. 1 minute charts only go back, 30 days. You can't draw them in earlier than that. So what I try to do is draw these in and duplicate them as much as possible, because once you have your anchor point in the 1 minute and it goes back beyond 30 days, that anchor point is still there. And I believe you can actually go into the properties and edit exactly where it starts. So you can say, I want it on this date and this time at this minute. So if you know to the minute where you want to start this line, you can edit it directly and actually put it in there, which will then translate much further back than you could actually manually plot it on a chart. And then it's a higher scale. Even though it's a 1 minute trend line from the 1 minute chart, you're plotting something from a much higher scale. So this is a daily trend line right now, and it's definitely proving useful on the smaller charts. It's proving stronger because this is now getting respect here. Like none of these were getting respect. It was all of these would consolidate and then break through, and then consolidate and break through, and finally when it does respect this trend line, then you know this is the boundary of it on a bigger scale, because the origin is on the daily level. This is 2 days back. So this line then suddenly becomes pretty important, and you can actually risk off of it multiple times, all the way down. You know, and you can capture a pretty big move that way, and it gives you the confidence to stay in because you're looking at a higher scale. You know, it's not just a candle pattern at this point. You know why the candle pattern is working, and it's because of all of this internal fractal buying and selling activity inside of it. The candle patterns themselves are just a shorthand. It's just a way of like saying probabilistically this tends to move down. But the reason is because it's consolidation at this level, because price dropped, buyers came in, and now buyers and sellers are exchanging risk in here. But the buyers can't overcome the sellers and eventually fall off because they've gotten exhausted. They become part of the feedback loop that pushes price down because they're selling out. They know that they're not going to be able to continue to move up here. This consolidation has proved stronger for that buying and selling ratio and pushes it down. And that's why this works. But if you know the structure underneath and how to read that structure in terms of like the finer grained, lower scale chart movements, and what those translate to on a higher scale, you can see why it's working on the lower scale, not just because it's a 3-bar play, but this would also tell you like if price managed to break up a little bit here more, and not really get down below this level, then this is why this 3-bar would fail where others would work, and without looking at the microstructure you would never know that. And this is true like of every single pattern, the pattern of candles that you can come up with, is that on a higher scale these patterns are forming from the price action of the lower scales, the risk levels of the lower scales, that and that includes these trend lines, which are just incredibly important in terms of evaluating the rate of return, because it's the rate of return from this point on a daily level. This is the biggest rate of return that's influencing all of this price in here. There's a bigger rate of return from the weekly and monthly level that is a much shallower, but we also haven't gotten back up to that yet. But once it does, I would expect price to reject off of it, because if we're on a downtrend on a monthly scale, then holding a long for weeks is a bad idea. I mean, you want to get in as high as possible and hold short for as long as you can when the higher trend is going down. So this is why, like, looking at the micro, the fractal structure within these, it helps you make better trading decisions on a higher. It gives you the confidence to get in and stay in. And to understand that your bias is scale based. Like you are biased short on the daily level, but in here with this volatility, I mean, you may see this down here and the rejection of this 5-minute movement and decide to take a long here. But you'd have to know that you're in a context of a larger, and on a 4-hour it's just consolidation. So like you should be scalping this. I mean, this is not a 5-minute buy and hold investment. I mean, you're scalping this because this 4-hour and the 1 hour is even, more choppy consolidation. But on the 5-minute, you would never know unless you looked out at the bigger structure. So that's why these candle overlays are handy to sort of, it's like training wheels for understanding the fractal microstructure of these candle patterns.